As of the end of 2025, the average new car payment is now over $750 per month. In the beginning of the loan term, much of that payment is interest. Well, the One Big Beautiful Bill Act, or OBBBA, contains a provision that gives a tax break for paying car loan interest, at least for people who have loans on new, American-made vehicles. I'm the Tax Geek, and here is the car loan interest deduction, oversimplified. The car loan interest deduction is a tax deduction of up to $10,000 of the loan interest paid on a car loan for the purchase of a new American-made vehicle purchased between 2025 and 2028. Interest on up to 2 vehicles may be used to claim the deduction, as long as the total deduction doesn't exceed $10,000, and you don't need to itemize to take advantage of this deduction. However, depending on how your state calculates taxable income, this deduction may still be subject to state income tax. The vehicle must have final assembly in the United States. You can use the NHTSA VIN decoder website at vpic.nhtsa.dot.gov to find out if a vehicle qualifies. Don't simply rely on the make of the vehicle. Many domestic nameplates assemble at least some of their vehicles in other countries, and many foreign makes have models assembled in the US. And don't rely on the word of a salesperson that the vehicle qualifies for the deduction. Verify it yourself using the VIN. And remember, only the interest component of the payments is potentially deductible, not the entire payment. Your final loan statement of the year should show interest paid year to date. For 2026 and beyond, the IRS plans to release a 1098 series document that will report vehicle interest to you and the IRS. If your adjusted gross income is over $100,000 or $200,000 for joint filers, the deduction is reduced by $200 for every $1,000 your AGI exceeds the threshold. For example, Tyler purchased a new Ford F-150 pickup in February 2025. In 2025, he paid $8,760 in interest to the loan company. He files as single, and his adjusted gross income was $125,500 in 2025. To calculate his deduction, he subtracts $100,000 from his AGI of $125,500, which yields $25,500. To calculate the reduced deduction, he divides $25,500 by 1,000, resulting in 25.5, which rounds down to 25. The 25 is then multiplied by $200, and the resulting $5,000 is subtracted from his $8,760 in interest to arrive at a reduced deduction of $3,760. To claim the deduction, you and your spouse must have Social Security numbers that are valid for work. The deduction is not available for married persons who file separately. The deduction is limited to your taxable income after taking your standard deduction or itemized deductions. It cannot reduce your taxable income below zero. Example, Edward and Gladys are married and have an adjusted gross income of $37,720. Their car loan interest on their 2025 Toyota Camry was $6,350. Subtracting their standard deduction of $31,500 from their adjusted gross income equals $6,220. Even though their potential deduction is $6,350, their deduction is limited to that $6,220, reducing their taxable income to zero. So now that we know how this new deduction works, how is it reported on a tax return? I'd like to introduce you to Schedule 1A, Additional Deductions. This form is where all the new deductions created by the OBBBA are calculated. Part 1 of the schedule must be filled out by everyone who claims a deduction on this form. This is your modified adjusted gross income. Unless you're excluding income from Puerto Rico or other foreign earned income, the amount on line 3 should be the same as on line 1. The car loan interest deduction is calculated in Part 4. First, the vehicle VINs and the amount of interest paid is entered on line 22. Lines 23 and 24 apply the overall deduction limit of $10,000, and the remaining lines apply the AGI limitations. To see how this form is filled out, let's revisit Tyler from the earlier example. Again, Tyler files as single, paid $8,760 in vehicle loan interest, and has an adjusted gross income of $125,500, which is entered on both lines 1 and 3 in Part 1 of Schedule 1A. The vehicle's VIN and the total loan interest paid is entered on line 13. Since Tyler is claiming interest for only one vehicle and it doesn't exceed the maximum allowed, the same figure is entered on lines 23 and 24. The adjusted gross income from line 3 is entered on line 25. The phase-out threshold goes on line 26, and the difference shows up on line 27. The difference is then divided by 1,000, and the result is rounded down to the next whole number. That number goes on line 27 and is then multiplied by $200, giving a result of $5,000, which in turn is subtracted from the total car loan interest paid to arrive at vehicle loan interest deduction of $3,760. This number is then totaled with any other Schedule 1A deductions he may have, and the result is entered on line 13A of his 2025 Form 1040. Taking his $3,750 vehicle loan interest deduction and multiplying it by his 24% marginal tax rate shows he saved $902 using the deduction. For now, this is all based on draft regulations and forms, which may change before the end of 2025. Additional developments will be noted in pinned comments and the video description, where you will also find links to additional resources and information. If you found this video informative, please give it a like and share it with anyone who can find it useful. Subscribe to the channel to see more oversimplifications of our increasingly overcomplicated tax system. And of course, your questions, comments, and suggestions are always welcome in the comment space below. Thanks for watching, and I'll be back soon with more of your taxes oversimplified.